Real estate investment trusts, or REITs, have historically performed great for long-term investors, even better than stocks. So why are they kept a secret, or why are they not in more investment portfolios? Today's guide will teach you the basic fundamentals of REITs and answer all the questions that you may have about them. By the end of this video, you'll have gained a significant amount of knowledge when it comes to REITs and know whether or not they're right for your investment portfolio. For people new to the channel, my name is Jake and I'm a huge personal finance and travel enthusiast. And so in today's video, we'll be going around to Inverness, Scotland. What is a REIT? REIT stands for Real Estate Investment Trust. You can think of a REIT as a mutual fund which only buys real estate. More specifically, you can think of a REIT like an ETF. And if you don't know what an ETF is, it is an exchange traded fund, and I have a whole video linked up above and down below which goes over how you can use them to invest like a billionaire. But back to this video, like an ETF, a REIT is traded on the stock market. This makes investing in a REIT accessible for anyone who has a brokerage account. A real estate investing trust, from a technical standpoint, is a company that owns and buys real estate only. A single REIT can hold hundreds of income producing real estate such as residential, multifamily, commercial, and even cell phone towers. How do REITs work? When you purchase a REIT, you're actually purchasing a stock in that company. You technically don't own any of the properties, you just own part of the company that owns those properties. Still, as a publicly traded company, you still have ownership of that company. So as a part owner, you reap some of those benefits like dividend payments. REITs are required by federal law to pay 90% of their profits to their shareholders, which is you. But it's also not uncommon to have a REIT pay out 100% of its profits to its shareholders. The structure of a REIT. When you hear the word REIT, what do you think of? Sure, you know what it stands for, and yes, you know that it invests in real estate, but what does it actually mean? For starters, it's important to know that there are several kinds of REITs. There are retail REITs, lodging REITs, residential REITs, timberland REITs, healthcare REITs, self-storage, and still more, but you get the picture. When you invest in a REIT, you're only investing in that one sector. For example, if you were to be investing in a self-storage, you're only getting that self-storage properties. You won't have exposure to shopping centers or to residential multifamily. This principle applies to every kind of REIT except for those which are the diversified or the specialty REITs. You can also buy a REIT ETF which will hold multiple REITs in it as well. This may be my preferred method because you want to get that added level of diversification. Why invest in REITs? According to REIT.com, an estimated 87 million Americans own REITs. However, that's not why you should invest in them. Like with any investment, you should make sure that they align with your goals. You should look at several factors before you add any new investment to your portfolio, such as performance of the investment, risk level of the investment, how long you hold the investment, how much diversification does the investment add to your portfolio, how hands-on or hands-off. Now, if this aligns with your goals and criteria, then you can go ahead and try to invest in this. And here are some of the major benefits of investing in a REIT. The obvious advantage of investing in a REIT is that you have exposure to real estate without having to deal with any of the headaches of actually owning the property. Yes, owning a property can be nice, but there are a lot of headaches that can be associated with that. The principle is this, is that REITs allow you to invest in real estate without any of the headaches. What type of returns? REITs have historically outperformed the S&P 500 index and other major indexes over the last 20 years. This basically means if you owned an S&P 500 ETF over the last 20 years and your friend owned a REIT, your friend got a higher return than you did. Does this mean you should stop investing in the stock market? No, not at all. The S&P 500's historical performance is only one measure of the stock market's growth. Many hedge funds outperform the stock market by investing in specific sectors. Another reason to invest in REITs is to get the diversification. Most investors have portfolios made up of stocks and bonds, and being able to add a REIT in there will expose you to an entirely different industry. Why is that a good thing? That is a good thing because if you have the stock market going down, you might have real estate going up at the same time, which will give you more of a balanced portfolio. There are more benefits to investing in REITs, and we'll touch on those those in a little bit, but first we should touch on the type of REITs, and there are 4 kinds. Number 1, equity REITs. The equity REITs are the most common type of real estate investment trust. When you see someone talking about a REIT, they're usually referring to an equity REIT. These REITs are owned and operated income producing properties and publicly traded on the stock market. These equity REITs make money by renting out their properties and paying 90% of their profits back to their shareholders. You can also invest in REIT ETFs, which usually always contain equity ETFs. Number 2, MREITs. MREIT stands for a mortgage REIT. With the equity REITs, and they own the property and collect the rents, but with the MREITs, they do not own any real estate. What they do instead is provide the financing to be able to purchase the property, sort of like how a bank provides you financing to purchase a home. The MREITs make money by collecting the interest on the mortgage. Number 3, public non-listed REITs. These are similar to equity REITs, but they're not traded on the stock market. Because these are not traded publicly, these are less common to see in any kind of portfolio. They're not listed on the stock market exchange, but they are still required to list with the SEC. Number 4, private REITs. Private REITs are generally sold to institutional investors such as banks, hedge funds, pensions, mutual funds, and insurance companies. Now that we know the kinds of REITs, let's dive back into the benefits of REITs. There are pros and cons to every kind of investments, and REITs are no different. But benefit number 1 is diversification. REITs provide you with an added level of diversification. For starters, REITs invest in real estate, which is backed by a tangible asset. And not only that, REITs have little correlation to stocks and bonds, which means when the stock market is going down, you could have your REIT still going up in price. Benefit number 2, liquidity. Liquidity is a term used to describe how fast you can turn an asset into cash. For example, stocks are very liquid because you're able to buy and sell them very quickly, while on the other hand, if you had a rental property and you wanted to get the cash out, that could take you a couple months to sell the house, to fix it up, and all that as well. During that process, the price of your home can change. It can go up, but it can also go down as well, which is not something that you would want. Why is liquidity important? Because of unexpected events. You never know when you'll have a giant tax bill or a medical emergency. It's nice being able to get the cash out whenever you need it. Benefit number 3, dividends. REITs pay quarterly dividends, much like stocks. As I mentioned earlier, by law, REITs have to pay out 90% of their profit to their shareholder. Dividends can be a nice way to get passive income, and if you're interested in this, I do have a video linked up above, which goes over some of my favorite dividend stocks. Benefit number 4, performance. REITs have historically outpaced the S&P 500 index. For example, according to NCREIF, from 1994 to 2019, the S&P 500 index had an average return of 9.8%, while real estate investment trusts had an average return of 10.5%. That may not be a huge difference, but over the course of years with compounding interest, that can make a huge difference. How to start investing in REITs. Once you've done your own research and know that you want to invest in REITs, now it's time to start investing. Here are some of my favorite REITs to invest in. Equinix Digital Realty Trust, American Tower Corp. Here are some of my favorite REIT ETFs. Vanguard Real Estate ETF, the iShares Core US REIT ETF, Fidelity MSCI Real Estate Index ETF, Spider Dow Jones REIT ETF. Buying REITs is like buying stocks, and you can do that within any kind of brokerage. And if you don't have a brokerage, 2, which I'd recommend, would be Public or M1 Finance, because if you sign up using the links down below, you can get free stock, which would be great. So adding a REIT to your portfolio is a great way to diversify without owning any of the actual rental properties. This can be a great answer if you want to get into rental real estate but don't have the money for a rental property, or do not want to deal with the headaches of actually owning a property. REITs are also easy to access and can be bought and sold from the comfort of your own home. Thanks so much for watching, and I hope you guys have a better idea of what a REIT is and whether it's going to work for you. And if you know anyone that can benefit from this information, then consider sharing this with them. And if you want to be around for when I post my next video, do not forget to subscribe. And if you want to grow the channel, then tap that like button. But I will see you guys next time.